So, welcome to this simple analysis of KID. It is a stock that is, well, supposedly sensitive. Quite an interesting stock, I would say. And what is actually KID? It is a modern, luxurious retail seller. So it is doing interior though. What you see inside, you can most likely get at KID. And it most likely looks pretty. So where is KID based? Well, KID Interior is based in Norway. KID Interior consolidated with Hemtex in 2019, and they are set in Finland, Estonia, and Little Sweden. So, what is the benefits of KID? Well, they are currently at a dividend yield at 9%, if I'm not mistaken. They are well driven and they have a varied evaluation. It gives you more or less the possibility of a good entrance. They also have a positive growth to both top and bottom line, at least from 2014 to 2021. So, what is the negative side of KID? Well, honestly, when COVID happened, they fell extremely high. So it correlates a little bit with the varied evaluation where they are really sensitive. Like it's in a sensitive segment, right? And it literally means that if you came in high, you kind of like have the other side of the varied evaluation. You're not getting out before it's too late. It's currently in a economical downturn, so they might struggle with that. They have had a varied equity. So in 2020, during COVID, their equity fell quite a lot, and it's been slowing building up since that. And they're currently struggling a little bit with shipping costs, you can say. They were also in 2009, like the last financial crisis, saved from bankruptcy by DNB. And, well, saved might be the wrong word, like DNB took them in, drove them further, and sold them in 2012. So, yeah. So, simple key ratios in KID. Well, the margin is normally above 10%. They have a varied return on assets between 5 and 12%. It has been consistently increasing the return on equity. But now with a lower equity that came in 2020, it's a little bit skewered. So 2020 and 2021 have a 30% return on equity. So I'm a little bit scared about using it. When it comes to the equity per share, it's bumpy. So some years it's a negative growth, other years it's a high growth, 23%. It's delivering, I would say, even if it is a little bit bumpy. When it comes to the PE values, it is normally below 15. So well, it goes in. You have the possibility to get the share at somewhat decent levels. I think currently it is at 9%. So how is 2022 for KID? Well, you can see it's not really that enjoyable. They have strong headwinds from several areas. For example, shipping, consumers, decrease in retail, generally from all sides. Like you have increased interests, lower income, and higher salary costs. Like it's headwinds from basically everywhere. The inflation, yeah. And well, it is a what you can call a huge evaluation fall. So economically, well, the margin is currently at 5.8%. So when it's normally above 10%, it's quite the fall. It is a high pressure on the margin, and it looks like it might continue. The top line is 3 times higher in 2021 than it was in 2014, and the bottom line is actually 4 times higher from 2014 to 21. So the question is, how will Q4 be? It looks like it might be a rough end of the year, and it might be rough next year. So it will be interesting to see where it will go. Debt and debt handling. My favorite thing about KID is actually that they're trying to pay down their debt. A lot of companies on the stock exchange is actually not really trying to pay down the debt. So I actually do like that. You have a few spikes here. You have in 2019 with the consolidation in Hemtex here. And you have the one that I like the least, and that is in 2022. This will increase the interest, and it doesn't look too good from my point of view. They do have a high lease cost. I have not added it in the numbers here. In total debt it is. But the lease costs can create some issues. We will look deeper into that in the cash flow. They have also been increasing their total debt. You can Well, in 2022, you actually can see that it's not increasing, but the year before that, it is. So they literally have higher inventory, for example. They have an uneven equity. Not sure if it's fair to add it. It's literally COVID happening, right? They fell down a lot. They struggled a lot, but economically they didn't struggle. They benefited from it. We will also go deeper into that. And the bad history of 2009. Well, they went bankrupt. Bankrupt. They struggled with debt. DNB took over and sold them further in 2012, and the rest is history. So the cash flow, well, it's actually increased 5 times since 2014. They had like this small downturn here in 17, but look at 20, look at the COVID. Everyone was sitting inside. No one liked how it was home and just fixed their apartment or house, it looks like. So yeah, 5 times since 2014. Of course, if you go in and look at the consolidation 2019 numbers, might be a small correlation here, but other than that, 2022 is quite punishing. Q1 to Q3, look at this, negative cash flow. You can see the dividend. Normally they have very good control of it, but the current dividend, well, paying dividend with a negative cash flow means it's debt. Simple as that. The lease, 200,000. So right now it's like negative 500. 40,000 cash flow, 260,000 dividend, 200,000 lease. No, not good. They have borrowed 275,000. 2022 is quite punishing, and well, 2023 can be worse. Not in the shipping rates, but certainly in the consumer behavior. Inflation is already making it difficult. The Ukraine war is already making electricity difficult, costs, food costs. Like, it's so many things that will be added into the wallet for the regular person. So it might be that luxury goods aren't that interesting for the regular person. We will see. Q4 will be super interesting. Q1 will also do a very good indication. If you're interested in KID, I would recommend you to strongly pay attention to how Q4 looks compared to last year and Q1 looks compared to this year Q1. It will give a very clear indication of how the market might be in the short to medium term. The fourth quarter, well, very important. The last 14, like since 2014, the fourth quarter is literally half of their equity per share. So I really recommend watching Q4. The weather reports, incoming headwinds. Well, low purchasing power from customers, high lease costs, high pressure from an increased salary and electricity costs from the stores. Like, they have quite a lot of stores. I think it's over 150 just KID alone. Increased interests. The possible backdraft, like the positive things, is the shipping rates are looking lower than what they have been, and the top line is still positive. So it should be mentioned that the shipping rates are mentioned in their presentation, while the high pressure from increased salary and electricity costs is not. So they are saying, like in their Q3 presentation, that the shipping rates alone is enough to make Q3 look worse. So shipping rates are interesting. Look at the Q3 presentation for more information about that. I would recommend that. How is KID ASA going forward? Well, short to medium term, I would say it looks a little bit difficult. They are lowering, if not removing, the dividend. You could see it in the cash flow as well. It's like 2022, the dividend have been lowered. Like, I had added the cash flow like the dividend that is going to be for delivered now 7th of December. So that is calculated into it. Possibly a small error in there, but like, it should be give or take close enough. Yeah, so they actually might remove the dividend if it's going bad enough. Lowering the top line and possibly negative bottom line will most likely be happening. So you can already see the start of the lowering of the top line now in Q3. We will take a short look on that, at least in cash flow, I think. And it's also possible that they will get a negative bottom line, like if their margins continue to lower, if the shipping rates stay high, costs stay high, it will be difficult. Of course, they get most of their EPS now, so Q4 should not be something like that, I imagine. But yeah, I've been wrong before, but I'm really looking forward to the Q4 actually. The negative free cash flow might be continuing. Shipping costs will be added in. Will be interesting to see. They have an increased debt, and they might continue increasing it if they don't get positive cash flow. Well, they have high lease, they have interest that needs to be paid. It's a spiral going down. So then we can go into the danger of the economical downturn in 2009. Well, 2009, the user segment was we can't afford luxury goods, right? Like we had a financial crisis. And is this the history? Is this a repeat of it? Well, generally, I don't really think so. I think they are healthier now. I have not checked their numbers though on how it was, but like from how well they have been driven towards today, I'm not that worried about it. Will Q3 repeat? Well, yes. Q3 will repeat. Just in the Q3 presentation, KID even stated that they will not meet the yearly targets. They have stated that the shipping rates are difficult and they're looking forward to lowering those rates. Yeah, they are saying that the inventory that they have is with the added shipping rates and that will be visible in Q4. So we will see. About the picture here, the extended retail concept, that is something new that they're trying. They're going to add furniture like beds, sofas into their mix, and it's starting with 5 physical stores and the online store. From what I understand, it will start in Q4 in at least the online store, and in the physical stores it will be a little bit more varied, and the rollout plan will of course be based on the pilots if it's successful or not. So, will the past repeat itself? Generally, I don't really think so. You can see the net cash flow though, it's not looking too good. Like you have 190 here versus 50, so that is 3 times lower than what it was last year. So it indicates quite a lot of difficulty. You can also see that we can focus on the 22 part for now. The cash flow from operations is actually lower than the lease and the net interest, and you can see the net change in cash and cash equivalents is at minus 4,000. So they literally sit there now with 6,000 million zeros, right? Left, I'm a little bit worried about like their liquidity, especially now that the dividends are going out as well, and you can compare it to the health from the last year, right? It's like here you have like the 189, they pay down 65,000 in debt, and then like they start it with 60 and they still increase it. So yeah, it looks like they need to pay the dividend they might need to pay dividend here in debt, but we will see. Again, Q4 is literally their biggest quarter. It might be that they really will show off, or it might be that the struggle of the shipping will really, really penalize them. They have stated they will not meet the expectations this year. How about it is? I'm not sure. Might be that I'm escalating it. So based on that, I should go through the disclaimer. Basically, this is not financial advice to buy or sell, KID. It is just me talking about a Norwegian stock, hopefully giving some insight, giving some new ideas, some thoughts on some numbers, helping you a little bit. I really enjoy talking about stocks, and this is pushing me to going deeper into shares or stocks that I'm interested in. Mainly, I'm doing dividend companies, but I'm open to a little bit of other companies as well. Thanks for listening, and hey, have a great day. Cheers.